Hey everyone, so today I want to talk to you about the magic formula for investing and picking good stocks. And this is not just a magic formula, but it is the magic formula created by an investor named Joel Greenblatt. And he gives you an outline and a method for screening for stocks that are not only cheap companies, but good companies as well that you can buy at cheap prices. So why does Greenblatt call it the magic formula? Well, he actually used this formula as a way to screen for good stocks at cheap prices, and he used it when he ran his own hedge fund. And while using this strategy, he was able to return from the period of 1988 to 2004 an annualized return of about 34%. I mean, that's absolutely incredible. 34%, that's almost unheard of. Now, at the same time, the S&P 500 had returned about 14%, so he had significantly overperformed the market from 1988 to 2004. He wrote about this strategy in the book he wrote called The Little Book That Beats the Market, and it talks about how exactly his magic formula works and all of the details, but today I want to give you a short summary of what he goes over in the book, and hopefully you can decide for yourself if it's something or a value investing strategy that you want to take a look at for your own portfolio. So a good summary of his strategy, as I mentioned before, is how do you buy good companies at cheap prices? What's the best way to find these companies? Well, first of all, let's go ahead and define each of those. So what exactly is a cheap company? So Greenblatt uses the metric earnings yield in order to find cheap companies. And earnings yield is the exact opposite of the PE ratio. So earnings yield is going to be the earnings per share divided by the enterprise value of the company, or the overall value of how much the company is worth. So the best way to imagine this is imagine you have two separate companies and they're both trading $10 per share of the stock. Now, you want to also take a look at the earnings per share. And let's say, for instance, that one of those companies gives you $2 per share of earnings, so $2 for every $10, and another gives you $1 per share. So in this case, it's cheaper to buy the company that gets you $2 per share instead of $1 per share, because if you're paying $10, you're theoretically getting $2 back instead of just $1. And that would mean that it's cheaper to get more return on your money if you pay the same price and one of them actually gives you more earnings for that $10. So paying $10 for $2 is cheaper than paying $10 and getting only $1 back. So that's a good summary of how exactly he's looking at what are cheap companies by looking at what he calls the earnings yield. So the second part of his strategy is finding good companies. And so he has to have a way to look at the financials and figure out very quickly what is a good company. And the way he does that is through a metric that he calls return on capital. In his book, Greenblatt uses an example of a candy store versus a broccoli store to talk about return on capital. So let's say, for instance, it took you $400,000 to start up both businesses, okay? $400,000 for the candy store and $400,000 for the broccoli store. Now, if the candy store, you are able to make $200,000 per year from the candy store after all is said and done. So when you profit, you make $200,000 a year. That's a 50% return on capital there. You spent $400,000 and you got $200,000 in profits back on that specific year. Now for his broccoli store, let's just assume that people aren't as interested in broccoli and so the sales are not nearly as good. So if he makes only $40,000 per year in profit from the broccoli store, that's only a 10% return on capital because he spent $400,000 and you only get back $40,000 from your initial investment. So that's the way he looks at return on capital, and that's an easy way to conceptualize it. And as you can see from these two examples, if you had to choose to invest in either the candy store or the broccoli store, well, in this case, it makes complete sense to invest in the candy store because it gets you a 50% return on capital versus a 10% return on capital. So how exactly do you implement this strategy? Greenblatt wants you to remove all companies from your analysis that have less than $50 million in market cap because those businesses tend to be very volatile. He also wants you to exclude any financial, utility, and foreign companies simply because their accounting can be a little bit wonky, and then the numbers that they report for their accounting won't actually mesh very well with the metrics he uses to screen them out. So next, all of the companies that are left on your list, you're gonna wanna give each of those a ranking by return on capital and a ranking also by earnings yield. So the company with the best return on capital is gonna have a 1, and then there's gonna be a second, third, fourth, so on. And then you're also gonna rank the companies by earnings yield. And so the company with the best earnings yield is gonna have a 1, then the next company is gonna be 2, 3, 4, so on. So after you have those rankings, then you're actually gonna sum up the two separate rankings as well there. And then the lowest number, the companies with the lowest numbers are gonna be your best investments. Simply because if you have a company that is going to be the first in earnings yield and then also the first in return on capital, well, 1 + 1 = 2, and that's theoretically the lowest number that you could have. So the lower the number of the summed rankings for each of the separate metrics, the better the company performs. So after you've ranked those companies separately by return on capital and also earnings yield, you're gonna go and sum up the two rankings, and the companies with the lowest number are gonna be the best companies to invest in according to their earnings yield and return on capital. Because remember, you want to find good companies at a cheap price. And so for the top 30 companies that you find after you sum up the rankings, pick about 20 of them, take a look at them, and invest in 20 out of 30 of those companies. And the way it would work is that you would make an investment for about a year. So if you lose money on the investment, you want to sell it about 1 week before the year is up. And then if you've made money on that specific stock, then you want to hold it for at least 1 week later than a year and then sell it. So why exactly would you want to, sell it before a year if you've had a loss, or, sell it after 1 year if you've had a gain? Well, the whole reason is to make sure that we optimize our taxes. So you'll pay a lower tax rate if you make a gain and it's considered a long-term capital gain. And the reason it's considered a long-term capital gain in this instance is because you've held the stock for longer than 1 year. Now, if you've had a loss, then that would mean that if you sold it before 1 year, that's a short-term loss, which essentially you could deduct from your regular income. So if you're kind of overwhelmed by that entire process that I just told you and thinking, oh, how would I possibly be able to do all of that? Will I have to subscribe to some sort of stock screening service or anything like that? Well, Joel Greenblatt actually released his own website called magicformulainvesting.com, very appropriately named. And what you do is you just create a login, and then you put in the market cap under which you don't want any stocks in there. So you can just put in 50 million like I talked about before, and he'll automatically run through all the numbers, take a look at all the different metrics, do the calculations, and spit out a list of 30 to 50 companies that you can take a look at for closer inspection. And hopefully you may want to invest in one of those companies because they are technically good companies at cheap prices. So how exactly has this strategy performed over time? Well, back from 1988 to 2004, it performed tremendously, absolutely destroyed the market. But more recently, there's been some success as well. So from 2003 to 2015, the Magic Formula actually returned about 11.4% versus the S&P 500, which had returned about 8.7% in the same time frame. Now here's the catch. Most recently, from 2015 to 2019, the strategy actually hasn't performed all that well, and it's underperformed the market significantly. And this is always something to think about with any single stock, any sort of stock strategy or anything that you may follow with regards to investing, is that past performances are never indicative of future results. And of course, that's always a tenet to remember if you're an investor, that just because you've done well in the past doesn't mean you're going to continue to do well in the future. Anything can happen in the market. But this is something that Greenblatt actually talks about in his book, that just because his strategy has done well for the past 20 years at the time the book was written doesn't mean he'll always do well in the future. He even admits that in the short term he may actually not beat the market. But his point is that anybody who chooses to use his strategy over a long period of time, 40 to 50 years, they are almost guaranteed to have a good investing success, and he claims that you should be able to beat the market should you follow this strategy consistently over a long period of time. Thank you guys for tuning in today. If you like these videos, please make sure to actually hit that like button, subscribe as well, so that way you know about all new content that I'm coming out with. In addition, it really helps me out with the YouTube algorithm, so you're doing me a huge favor by pressing that like and subscribe button. And I'll also post a link down below for magicformulainvesting.com, to where you can actually take a look at the stock screener and figure out what stocks are there and available. And by all means, please let me know if you have any questions in the comments below, or if you have anything that you want me to talk about in the future. I'm more than happy to make a video for it. So hope you guys take care, stay well, and looking forward to seeing you guys next time.